Let's get to hot picks. Our guest has 3 software ideas for you. He is looking for an acceleration in revenues linked to artificial intelligence. Let's get more from Gil Luria, Head of Technology Research at D.A. Davidson. Gil, always great to talk to you. Just remind us, we have heard this worry AI will hollow out traditional software companies, and of course it's going to vary. But what is your thinking when you hear that thesis?
That it's not going to be any different than any other technology cycle we've seen, which is to say, good companies that execute well will not only survive the AI revolution, they'll thrive in it. But that's not the market narrative. Software stocks have done very poorly the last couple of years because there's this notion that you can magically replace all of software with AI, that you can snap your fingers, vibe code some software, and companies will have a brand new marketing software, content management software, or enterprise resource planning software. We don't think that's the case. We think AI will get integrated into enterprise software gradually over the next few years, but good software companies will continue to do well. And this is the year where we think investors will learn that AI is not going to run over their software stocks.
Start off, if you would, with Manhattan Associates. They're in supply chain software. What attracts you to this stock?
This is a company that has very strong domain expertise in supply chain. That's warehouses, logistics, retail. Their customers default to Manhattan Associates software in order to manage complicated supply chains. It's very recurring revenue. Manhattan Associates has an army of consultants that have this very unique expertise in helping those participants manage their supply chain. Their next competitor is much smaller than they are. So they've been doing well and they'll continue to do well. And this is actually a year where, after a little bit of an air gap, they're going to have an acceleration of revenue growth in their cloud business and in their services business. And yet they're trading at the lowest multiple they've traded in a long time.
You have another idea for us, Zeta Global, which is a marketing software company. Just tell us what kind of software they provide and why do you think the stock holds promise?
So they help marketing departments get customers, know how to reach out to those customers and engage with them. But they also have a business with advertising agencies, especially digital advertising agencies, where they help those agencies reach customers, find out what the segmentation is, and be able to address them. And that's a business that's growing even faster than before. So they can serve that whole marketing ecosystem. They've been doing it very well. They're gaining share from companies like Salesforce.com. And that's why they've been growing so much faster. And we expect them to do that this year, exceed expectations, and even do it at a higher than expected profitability rate.
It is interesting. I mean, just remind us, we got this move, like so many other companies, they want us to pay for streaming. Don't just want to sell us a product one-off. Is that the name of the game now in software? Software as a service, you pay a regular fee?
Yes, for all these companies that we're talking about today, it's mostly hosted SaaS revenue, meaning it's recurring revenue. You sign up with one of these companies and you pay the same every year, and then at the end of the contract, upon renewal, it actually goes up a lot. That's part of what makes software businesses great. It's recurring revenue, it scales, and it comes in at very high incremental margins. Mm-hmm. Their gross margins are typically in the 70s or 80s, with very little need to increase the fixed cost. That's what makes software companies great businesses. Mm-hmm. The market's just forgotten that over the last couple of years because of the AI craze.
That's interesting. Finally, Box. Remind us what they do and tell us why you like the look of this one, Gil.
Content management. So instead of we as consumers have our iCloud or Dropbox, companies use Box for their content management. And Box has done a really good job of adapting to the age of AI. Since they manage unstructured data, so not just numbers in columns and rows, but documents and other things that don't fit into a box neatly, they are really having a resurgence right now. And we have a chance to see them accelerate revenue this year. And then that's not reflected in the stock at all. It's trading in the low teens on their cash flow, in spite of the fact that they're already showing signs of acceleration into this year. And Aaron Levy, the CEO there, is a very important figure in the tech community. He's a real thought leader in where AI is headed. And we think Box is going to get more and more credit for having that leadership position.
That's interesting. And you said that Catalyst will be accelerating revenue, Gil. Just tell us what your thinking is on that.
The point is that over the last couple of years, most software companies have seen decelerating revenue, not because AI has disrupted them, but because AI has distracted their customers. Their customers have spent so much money on internal efforts to figure out what to do with AI that they've neglected their software stack. This is the year where enterprise technology customers now have a good understanding of what AI can and can't do, so they can go back to managing their business, which is to say, buy more software. That's why we think after a couple of years of decelerating growth, this is the year where good companies, as like the ones we just talked about, will see accelerating growth this year.
Gil, always great talking to you, and thank you very much indeed.
Thank you.
Gil Luria, Head of Technology Research at DA Davidson.